Hey folks, welcome to Fun with Finance. And today I'm going to share my story with you guys of how I invested in one stock that nearly doubled within 5 or 6 months, then went down the drain, lost almost 70 to 80% of its value. And now I'm back to breaking even. I've broken even like a month back and I'm in some profit. But I wanted to share my learnings with you so that you guys could also learn from that and make sure you guys don't commit the mistakes that I did. So, first of all, yeah, so I invested in a stock named Palantir. I'm sure you guys would have heard of it. So, it was based on a YouTuber's advice, and that's my first learning that you should do your own research and not follow anyone. And what happened was so let me bring up Palantir. Yeah, so I started investing around $15 and it almost doubled or got to around $40, even $45. That was the peak, I think, at which it reached. And I told my friends, okay, guys should buy, you guys should buy, it will double in no time. It did. But the problem is I didn't know when to sell. So they also didn't sell, they kept holding on. And as a consequence, it went back to around $6 or $7. It was $6 or $7 for 5 or 6 months or maybe more. But yeah, so my friends were shouting, "What the hell?" And then I said, "I'm sorry. What else could I have done?" But they held on to it, and now they've broken even. So at least that saves me some of the abuses from them. I'm not sure. So that's my learning. First learning, as in, don't follow any YouTuber's advice. Pick the stock. Do your own research based on your own research. And so the major learning is how not to pick a stock. So initially, when I started investing, I thought, okay, I'll invest for 2 years or 3 years. But let me tell you one thing, investing based on a time frame, say you'll invest for 3 years or 2 years, that's not a good idea. And that's even Warren Buffett has said, like, don't invest in a stock or in a company that you can't hold for 10 years. So time frame, investing based on time frame is never a good idea. So how should you invest? Then I got to thinking, okay, what should be the best way to invest? And then I watched Shark Tank. I'm sure many of you guys would have watched that. And how do I thought about, like, how do sharks pick a stock? So there are two things, the tangibles and the intangibles. The tangibles are like the P ratio or the revenue or the demand that the product of the company is having, or the future demand, and how much liquid money they have. That's all the tangibles based on which you could estimate the value. If the stock is undervalued or overvalued, we'll get into that. And the other factors are the intangibles, like how the management is, how the leadership of the company is, and how the culture is. Is it a good culture? Is it a bad culture? So those factors also come in. So based on these factors, I think the sharks finally invest in a product, or in a person, the company that they're building in Shark Tank. And so let me take one example out of these tangibles. Let me put in P ratio, because most of the of people or the YouTubers or the major investors I've seen follow this psychology, as in they refer to PE ratio. So what does PE ratio mean? So PE ratio is price to earnings ratio. Say, for example, a company has 100K profit and it has around 50K outstanding shares in the market. So again, the earnings per outstanding share would become $2 in this case. And say the stock value is $30, then the PE ratio would become 30 by 2. That's 15. So basically, they are paying the earnings per share is $2, so P ratio would become 15. So the point is, if the P is lower than what the average P for the companies or the competitors is, it's a good investment, because you're paying lower amount of money for per dollar of earnings, right? Lower amount per dollar of earnings. But if the prices of the stock would be more, in the case it's overvalued, you'll be paying more than you need to. So you should pay always lower than how much the competitor P ratio of a companies will be. I'll talk about this more. So say, for example, let's take an example of PayPal. So PayPal right now has PE ratio of around 30. and over the past 5 years, its average has been 48. So right now and I was reading about like what's the competitor P ratio for the PayPal in the payment business for where other competitors are placed. So I was yeah, the peer average, as you can see, is 30.7, and it's right now is 30.1. So it's around that ballpark, and the average PayPal P ratio over the past 5 years is as you can see, around last 5 years peaked at 87. So it's been 35 and 87, between 35 and 87. So right now it's at 30, which is a good P ratio to bet in. And so if you believe in the company, and then I think it's a good deal. So that's the psychology. Like I've realized, okay, if you want to invest in a company, make sure that its intangibles are good, then based on the tangibles, it's undervalued. And how to determine it's undervalued would be based on this P ratio. That's one of the metrics folks use. So and yeah, and once it becomes overvalued, or once you achieve the certain amount of profit that you wanted to achieve, or once it becomes overvalued, you should sell out or at least take some of the profits. So in conclusion, you should try to find a stock or the company that you believe in that has good intangibles. And the tangibles, or like take an example, say P metric is lower than the peers. That proves it's undervalued. That P ratio is one of the metrics that you could use. Make sure you guys buy it when it's undervalued and it's a company you believe in. Thank you guys for watching. Hope you guys like the video, and for more videos, please subscribe and please like the video. That will help a lot. Thank you.